Hey, it's Mitch Goldberg. Welcome to Be the Boss of Your Money. This is my live stream. We do this every day, Monday through Thursday, at 4:30 p.m. Although it's a little bit past 4:30 p.m., but one of those days, just all over the place. I was literally out all day. I actually just walked into the office now, flicked on the light switches, hit the cameras, and we're live. That's all it takes, right? And if you are a live streamer, you create live content, you know how important it is to have a setup that is always ready to go out of the gate. You just flick a couple of switches and you're live. We're talking about the market though, big bounce. Don't think because I've been out all day on appointments, don't think for a second that I don't have my finger on the pulse of the market. And that I do. We're going to talk about this. Is today's bounce believable? Because last week, people were thinking, oh, we had this rally on Friday. It's BS. It's not going to last. I doubt it. And all of a sudden today, people are coming out of the woodwork saying, I believe in this rally. This is a serious rally. We've hit bottom in the market. Everything is factored in. We were oversold. You want to know something? Here's how I look at it. People ask me all the time when the market goes down a lot, did you sell? Did you get out of stocks? Should I get out of stocks? Here's what I tell them. First of all, you should have your emergency fund. Okay, cash emergency fund. Second, money you're going to need for expenses over the next year, could be 2 years, that should be in cash. That should be out of the market. The rest of the money you have in the market, or the rest of the money you have, gets invested. It gets invested according to your risk tolerance, your time horizon, and your financial goals. Your time horizon is typically what establishes your risk tolerance. The more time you have, the more risk you can take. The less time you have, the less risk you can take. That is so important to know. I know it sounds so elementary, so basic, but I feel like we need a reminder of that when people ask me, did you get out of the market? The money that you have in the market, that could be rebalanced, it could be invested in a certain way based on your risk tolerance, time horizon, and financial goals. That's my answer, and it doesn't change. All right, we're going to have a good show today. I want to go over a couple of things. So let's roll a quick intro, and then we'll let it fly. Here we go. All right, thank you so much for joining me. Let me turn down the background music. And here we go. It's a new thing. We have background music built into the stream as opposed to me piping in my own music from an external source. Anyway, I'm Mitch Goldberg. We're just getting started. If you have any questions about personal finance, investing, certainly about the content that we're talking about today, please hit me up in the comments. I love hearing from you. It's the best part of doing this. If you would like to, certainly feel free to leave a like, an applause, a heart, whatever the reactions you are allowed to use, depending on which platform you're watching on right now. We are streaming to a number of platforms at the same time. So whatever your preferred platform is, but right now we are streaming live to YouTube, LinkedIn, Facebook, and Twitter. We don't stream live to Instagram, but I do post all of the show highlights the next day on Instagram, as well as all of these other fine social media platforms. Okay, so hit me up with your questions. I love hearing from you. Words of wisdom, words of encouragement are always appreciated. Okay, so the market went up today. It went up quite a bit, even with Walmart down substantially, which the Dow would have been up even 100 points more had it not been for Walmart, about 100 points more. What gives? Today was a big day for retail. Retail sales figures were released. Are we in good shape? Is the consumer holding up better than we thought? There's been a massive amount of credit card accounts that have been opened. If consumers, does that mean consumers are feeling good if they're opening up credit card accounts because they want to go out and spend and they feel they could not carry balances? Or is it because consumers are worried that all of a sudden things are getting tight, no stimmy checks anymore? Um, Maybe job openings aren't as plentiful as people thought, and all of a sudden they're like, I better have a backup plan, a little bit of credit. So I'm going to get a credit card account and open that up. So it's tough to say because people could use credit card spending to keep the spending going and going, or they could just have that as an emergency fund in the back of their pocket. Now, just we were talking before, all right? An emergency fund. I just raised my seat. An emergency fund is not invested in the market. Okay, an emergency fund is a cash account. It doesn't matter if you're getting 0.01%. It's got to be liquid. That's why it's an emergency fund. And then you have a cash account, and the cash is for expenses you're going to need over the next year or two. Now, some people say over the next year, some people say over the next 2 years, some people longer. The idea is you don't want your cash for your financial needs invested in the stock market, because if the stock market goes down a lot and then you need to take money out to pay for financial obligations, you'll be selling into a down market. And since you'll have to sell more shares of whatever investment you are have to sell in order to raise the same amount of money, it becomes harder to make that money back, and that's called the negative sequence of returns. And that's a really bad thing to happen when you are newly retired, because right away in the beginning of your retirement, you're already setting yourself back. Anyway, money set aside for future expenses. Typically, I want that in cash. Now, it could be in like an ultra short term, ultra low duration kind of bond fund if you're willing to put up with a little bit of volatility and potentially take a little bit of a hit, just a tiny hit, if interest rates change. Because then what happens is if you keep too much money in cash, it's eroding from inflation and you're not really getting any return on it. But you really can't get a big return on it. And the reason is nothing safe pays a good yield, and nothing that pays a good yield is safe. So based on that, you don't really have a lot of choices of where to put your money, which is one of the reasons why the stock market went up so much in 2020 and 2021, because interest rates were zero and people wanted a place to put their money, and people going for dividend stocks and high yield bond funds, things like that. And now that things are down, people are starting to realize, well, maybe that wasn't such a good idea. I want to differentiate between people who are investing in stocks for an asset class exposure, like an S&P 500 index fund, just for your stocks. You can't invest directly into an index, by the way, but you could invest into a security that tracks or mimics an index, like an S&P 500 fund. Okay, so maybe you just want broad exposure, or maybe you want to really nail down or pinpoint your exposure. So you're going to buy individual stocks. So you buy some industrial stocks, some energy stocks, some financial stocks, some consumer staples, and healthcare stocks. Okay. But if you got into the pandemic stocks, what happens is you see a stock down 60, 70, 80% or more. The odds of you making your money back when you're down that much on a stock is incredibly low. If you're down 80%, stock goes from 100 to 20. Now it has to go up 500% to get back to even. How long does it take for stock to go up 500%? I know people got spoiled late 2020, 2021. Some stocks went up that much, that quickly. But generally speaking, that's not a norm. And you're probably sitting on losses that are, if not extraordinarily long term, they're permanent. So you need to decide what to do. And that's why investing in individual stocks is so tough. So, how do we get to today? Is this rally believable or not? Well, it's up, and if you sold into it, you would get more money today, presumably, than you would have yesterday. And the rally was pretty widespread, broad market rally. Will it last? You know, the bearishness was so thick you could cut it with a knife. People are saying, well, the war in Ukraine, the Fed has to keep jacking up interest rates. Inflation is eroding consumer spending and business spending like mad, and it's not going away. anytime soon. There's still something there. There's still a shortage of housing. Mortgage rates are way the heck up. Oh, so many negative things. But what we've talked about here is the possible good things like millennials spending money, which we've been talking about millennials, the millennial generation for like 20 years as a market force and an economic force. Well, they've been a market and economic force for quite some time now, and it's working. It's a bigger generation numerically than the boomers. So there are positive things, and today is a perfect example of why it does not pay to get overly negative. And this is why I just this is why I can't stand that when people say to me, "Oh, did you get out of the market?" And there could be people standing around that person saying, "Well, yeah, Mitch, did you get out of the market?" It's like such a dumb question. What do you mean? Why would I get out of the market? For money I need for an emergency fund or money that I'm going to need for a down payment for a house over the near term. Well, I didn't get that money out of the market because it wasn't in the market in the first place. I don't understand why you're getting out of the market. When are you going to get back in? When things are lower, when things are better? I say you're full of it. I don't think you're going to do it. And even if you get it right one time, all you have to do, even if you got it right 10 times, knowing when to get out and when to get back into the market. You just have to mess it up once after that, and you've ruined all the extra gains you've made by timing it right the first 10 times. So that's what I'm thinking. Got a couple of comments out here. We have Larry Lawrence Rojak. Thank you, Larry. It's I don't know if people call you Larry or Lawrence, but thank you very much. And you've been a supporter of the live stream and my content for quite some time. Thank you very much, sir. Why turn a paper loss into a real loss? I will put this up as an example right now. I want to show you guys something that I posted on LinkedIn today, which will help that. Exactly that. Ken, I know you're out there. I'm going to get to yours momentarily. Let's go here. I want to show you guys a post I put up today. I'll make this bigger so you could all see it. All right. Could you see that okay? Looks like we're in for this is what I posted this morning on one of the groups. I've been like 12 or 14 groups on LinkedIn plus my regular LinkedIn, my personal LinkedIn. So I post on all of them. But so that's why it says Long Island Business. But it's the same post. I'm going to read this to you. Looks like we're in for a rally in the stock market this AM. Will it stick around? Okay, we're getting into short-term. Okay, we're getting into short-term stuff here, but I think it's worth exploring how market movements work. Why? Because seeing your accounts drop in value could make you question your belief in long-term investing. Fear and loathing set in, and that could cause hasty decisions. All right, I'm getting to your question, Lawrence. First, I'm 100%. Just to reiterate Lawrence's question, will I turn a paper loss into a real loss? I'm 100% confident that investing for the long term is the best way to go for my clients and for me personally. I don't worry about bear markets because I know they will happen and because we set aside cash for near-term expenses and an emergency fund. This is what we've been talking about, right? Second, the risks of investing in individual stocks is very different than investing in stocks as an asset class, which an index fund is an example. Stocks in the aggregate recover, but many individual stocks won't. Okay. This is all right. This is what we've been talking about. I think it's important to have an understanding about short-term stock market rallies and retreats because it could help you avoid reacting to them. All right. So to answer the question from Lawrence, why turn a paper loss to a real loss? We go into the stock market typically brave and bold, kind of like, beer muscles, right? But when the stuff hits the fan, the beer wears off, where the stock market goes down, and you see your brokerage account statements go down and down and down for a few months in a row, your brain turns to mush. Not you specifically, but a lot of people, their brain turns to mush. They forget all about the long term and they think only the short term, the sky is falling, and they sell and they turn paper losses into permanent losses. When do they get back in? When things are better. That's bullshit, of course, because nobody knows when things are better. What does things are better really mean? When when the war is over in Ukraine, when we know that the economy is not going into a recession, okay, fine. Stock market will be back to new highs by then. And you'll have paid high, and then we'll go down for another calamity. And you'll do the same thing. You'll get out and try to get back in when things are better. And you're constantly buying high and selling low. That's a recipe for disaster. Just buy and hold and rebalance and stick around and understand that if you know that recessions happen, not just logically, but emotionally, if you know that bear markets happen, that it's part of the process, you will be much better at handling downtimes in the stock market. Now, if you're in individual stocks and you're getting wiped out because you bought these pandemic stocks, that's a different story. But I'm talking about the typical investor who's highly diversified investing in funds. Okay. But I hope that answers the question. Ken Shames, I saw the term Vixpiration thrown around all day. What is it and how will it affect the markets? The VIX. So the VIX is the volatility index. It basically measures the options market, short-term options trading between puts and calls, to get a gauge on whether or not professional investors are bullish over the short term or bearish over the short term. That's what that is. And when options on the VIX expire, it could cause the VIX to get a little funky, move up or move down a little, a lot more than out of the ordinary. And I think it's more or less just a conversation piece. I really don't think it means a whole hell of a lot. And even if it causes a little bit of extra volatility one day, markets get back to doing what they do, and we get past that. We have options expirations on and futures expirations all the time for different securities, and it's just a normal part of trading. And I don't really make much of a big deal about it at all. I don't even pay attention to. I'm aware of it, but it's done no good for me personally or professionally whatsoever to even follow that stuff. Okay, Phil is out there. Hey, Mitch, good show. Thank you very much, Phil. I really appreciate that. Thank you for all of your support and for being such a good friend. Let's take a look at the boards, okay? All right, so the Dow up 431 points, would have been up over 500 had it not been for Walmart. What happened to Walmart is, I think, unique somewhat to Walmart. Walmart is the biggest grocery store in the country also. And Walmart does not carry high profit margins on their products. They sell to a fairly lower end mass market. And I've been to Walmart before, so I'm not knocking anybody, okay? When I walk into Walmart and you see me in a Walmart, you could say, oh, Mitch is a low end mass market individual. Fine, you could say that. I really don't care. Whatever. I think I'm being smart with my spending, but I'm not just spending because I think things are cheap, right? I'm smart with my spending. But anyway, we digress. Walmart is a grocer, and food prices and gasoline prices, because Walmart is a big gas station too, have gone up so much that Walmart is just not making money on this stuff. It's crushing their margins. So even though their revenues were up, they just don't have the right mix of products, as opposed to Home Depot, which crushed earnings, crushed revenues, and raised guidance. Stock was up. They sell something different. They're not selling groceries. Walmart, in a way, is selling discretionary items. People go there when they're confident about their own economy and they want to fix up their house and do things in their house. So the Home Depot market, aside from the kind of companies, the consumers at Home Depot are considered different than the consumers at Walmart. I'm not saying Walmart shoppers don't shop at Home Depot, and Home Depot shoppers don't shop at Walmart. It's like a tongue twister. But when they're one store at another, but when they're at one store or another, they're different kinds of shoppers and they're there for a different reason. And Home Depot shows us that homeowners are still spending like crazy fixing up their homes. It's also a good indicator for the housing market. All right, so that's that. Back to the board. Okay, so Nasdaq up 2.76%. That is a pretty big day. S&P up over 2%. Gold off a little bit. Oil was off a drop. The U.S. 10-year was up a little bit, just a little bit. And the VIX was down 5% to 26. The VIX never really went that high in the last 2 months while the market's gone down in the last 6 weeks. But it's below 30. It's getting closer to 20. As it gets closer to 20, I expect this rally to continue. I think the rally drives the VIX, not the VIX driving the rally. But we see the VIX under 20, and we've got ourselves a bona fide, real strong rally in our hands. We're not quite there yet, but I could see us getting there. Okay, and the small cap index, the Russell 2000, Rus 2K. All right, this was up 3%, over 3%. That's a big deal. The Russell 2000 is small cap stocks. Bonds. Let's take a look at treasuries. Yields were up. Bonds were off a little bit. That's basically overall a slightly positive belief that the economy will be okay. And I just want to say, I just want to be on record for this. And I've said this before, but I want to say it again. If and when, it's not a guarantee, if and when the U.S. economy falls into recession, okay, by the time that happens, it'll be time to buy stocks. Okay, it'll be time to buy stocks, and that's how it works. Stocks are a forward-looking indicator. So when stocks, well, I should say, if we are in a recession, we go into a recession. I would expect that I'll be aggressive about loading up on more stock. Okay. And not for everybody, but some people rebalanced and now they might be more heavily into fixed income or cash. Some people have cash in the sidelines. Some clients have cash in the sidelines. Maybe just we raised a little bit before, and now we're going to put some back into the market. That kind of thing. All right. And lastly, we'll take a look at the crypto world, and then we'll get going for the day. All right. Decent day for crypto. Nothing amazing, but Bitcoin's back over 30,000, and as goes Bitcoin, as goes the rest of the crypto complex. Everything is trading in unison. All stocks, all risk assets, from blue chip stocks to speculative meme stocks and SPACs to crypto, are all trading together. They're all going up and going down in unison. The more speculative, the more it goes up in an up market. The more stable or a dividend-paying company is, or a low valuation company is, the less it goes up in an up market. But they also will typically go down less in a down market, and that's where we are. But it's good to see stocks up and bonds down for a change. So maybe we broke that little link that's been bedeviling investors for this entire year. All right, that's my story. I'm sticking to it. Thank you so much. If you have any questions to ask me after the show that you think of, or if you're watching in replay, definitely hit me up in the comments. I will see your comment. I would love to see your comment and answer your questions. And until tomorrow, have a lovely evening. Bye.